Move on to item 6.2, consideration of September 30th, 2022 report of Lake County pooled investments. With that, we'll ask the presenters to come up, and we have Patrick Sullivan, Barbara Ringen. We'll go from there.
Good morning, Board. Patrick Sullivan, County Tax Administrator. We are here with Ms. Barbara Ringen, Treasurer Tax Collector, and Carlos Oblitas from Chandler Asset Management to present the quarterly report.
All right.
Good morning, Supervisors. It's a delight to be with you once more. I'd like to update you on the activity on the investment portfolio and the economy. I'll keep it nice and brief and hit the highlights, and there's some questions I think that came out. I want to make sure that I address them before we leave. So unless you've been living under a rock, I think you're all aware that inflation is the big concern in the economy right now. Inflationary pressures, and Patrick, if we are able to go to page number 5, I think that'd be best. Inflationary pressures have really continued to weigh the economy down, although we're starting to see the inflation numbers come down slightly, which is giving some pause or some thinking to economists that the Federal Reserve may start thinking about pausing their path to raising rates. So let's back up for a second. We've talked about how the pandemic closed everything down, and that reopening and all the activity to sort of kick off the economy has placed a lot of demand on goods and services, so prices have been pushed higher. People have access to money and liquidity because they were able to borrow cheaply during the pandemic with very low interest rates, and they had pent-up demand because you couldn't take vacations, you couldn't buy certain things, you couldn't even leave your homes in certain instances. So now that things have reopened, people are out competing for goods and services, and that's pushed prices up. We've had prices through June reach the highest level that we've seen since the very early 1980s. We had the Consumer Price Index, which is a chart on the left-hand side, where you'll see that peak. It reached 9.1%. So you can see that that's now starting to come down. And the last reading that we had was down to 7.7%. In order to combat this, the Federal Reserve has been cutting off access to liquidity by reducing the money supply. That's fancy terms for saying they're making it more expensive for people to borrow money with which they go out and compete for goods and services. And hopefully that will bring prices down. That's sort of a tried and true method of doing that. So they've been raising rates. They manipulate the overnight lending rate between banks. That's called the federal funds rate. And if we go over to page number 11, that'll be the chart on the right-hand side. You can see how rates were on the rise back in 2016 and 17, and now then they came down dramatically as a result of coronavirus, and now they're on a path to raise that rate. That eventually gets passed on to the rest of the bond markets and the rest of the economy. By this action, they're reducing the money supply and making it more expensive to borrow, and that will hopefully keep people from consuming and driving those prices up. That's what they're in the path of doing. Why is this important to you? It's important because you have a fixed income portfolio. It's a debt securities portfolio, and your earnings from those bonds that you hold, every time you purchase a bond, you're purchasing a bond, you're lending money out, and you're going to get interest rate on that money that you're lending out, and that interest rate will be equivalent to whatever is prevailing in the market. And whatever is prevailing in the market has risen significantly. And if you go to the next page, on page number 12, the chart on the left-hand side shows that. We hit a peak of 2-year Treasury yields of 4.7. They're about 4.5% right now. That's up from 0.7 at the beginning of the year. So we've had this discussion. I don't think any of this is a surprise to the supervisors. We've been discussing this for several months now, and that's the path that we've been on. That has a dual effect on your investment portfolio. Number one, as rates rise, the underlying value of your investments goes down, and it's gone down dramatically. I'm sure your auditor controller booked a significant loss in your financial statements. That's a paper loss. You don't realize that unless you sell the entire portfolio, which is not the practice of the county treasury. So no worries there. The second impact that the rising rates has on your portfolio is that every time you have a maturity, that maturity gets reinvested in higher interest income. And I think it's valid to go to page number 17. And if you look at the very middle row, It's the average purchase yield. You can see that's the interest, the effective annualized earnings rate that you should expect at that point in time for the coming year based on the investments you have in the portfolio. So you can see that June 30th, that was expected to be 1.04. As of 9/30, it's 155. It's significantly higher. To give you an idea, I was looking at interest income on a monthly basis. Your treasurer tax collector elect and I were looking at this in the back of the room. And to give you an idea, when we were looking at this investment portfolio and we were starting to ramp up back in September of last year, 2021, we were looking at income of about $23,000 a month. Rates were very low at that time. Today, we're looking at about $545,000 a month coming into the coffers. For the last year, for the last 12 months, you've earned $3.3 million in interest income, just to give you an idea. So it's moving in the right direction. As you can see in the table behind us, the yields are coming higher. The portfolio is valued at $425.5 million. That includes the investment portfolio that Chandler manages on your behalf. It includes funds that are maintained in the state pool, local agency investment fund, some small funds in a local government investment pool called CAMP, and of course the funds that you have at the bank from which you cut checks and make payments for your obligations. That you'll see that that differs a little bit from the prior quarter. Obviously, there's a seasonality to it from the cash, the most liquid component, because as the year progresses, the county collects tax receipts, and then they spend it and they pass it on for all the other things that the county has to do. Obviously, we're now, today is the 22nd of November. In a few weeks, you're going to obviously see a ramp up of tax collections come in as people pay their property taxes. So those balances will start moving back up again, and then they'll come down a little bit, and then they'll do the same thing again in April. It's helpful to see on page number 18, you are very well diversified. The state pool, the state pool, just labeled LAIF, it's that green slice at the bottom, is about 15%, very liquid. That's what's held to make payments. Obviously, the cash, 6.2 on the, I'm looking at the chart on the left-hand side, the dark green slice, about 6%, that's the cash at the bank. But you can see that about almost a third of the portfolio is invested in Treasury securities, about 15% in corporates. The California Government Code allows you to buy as much as 30% in corporate securities, which generally pay you a higher yield. But with the kind of environment that we're living in, where financial conditions are becoming tighter, the Federal Reserve is in essence slowing the economy down by raising rates. And the opportunities for businesses to continue to grow at the pace that they had before are now diminishing. And some people think, well, perhaps we may be moving in towards a recession, a contraction of the economy. We're not quite there yet. When you have tighter financial conditions, the weakest corporate credits may have some downgrade activity. So for that reason, we tend to go up in liquidity and credit quality by buying more governmental securities. And that's why you're seeing, you can see that 3 months prior, Treasuries made up about 27%. Today they make up about 30.5%. Federal agencies made up about a little bit over 12%. Today they make up almost 16%. So you can see there's a little bit more of a bias towards governmental securities. It's not that we're seeing a credit event or we're seeing any danger in the economy, but when you have tighter financial conditions, we feel it's prudent to improve the credit quality and more so improve the liquidity of the portfolio by having very, very liquid investments. Looking at just jump over to page 20. So that yield that you saw that was at 155 in that table that I showed you, you can just see the progression of that yield going back to the summer of 2021. It's been on its way up. And there's two reasons for that. Number one, because working as a team with your treasurer tax collector and treasurer tax collector elect and the county treasury, we keep an eye on how much liquidity is needed. And when we have excess cash, that cash gets moved into the investment portfolio to be invested in higher yielding securities. So when we get a new influx of cash, that cash is picking up those yields that you saw that were rising in that prior chart. So that's moving the average yield of the portfolio higher. And of course, we also, when we're working with the ad hoc committee to determine our strategy, one of the things that committee, one of the decisions that the committee made was to maintain the weighted average maturity of this portfolio a little bit lower and the duration a little bit lower so that you would have more maturities coming due faster. And that's also been a function that's been driving these yields up. So that's just continued to be a good decision and a good position for the county. I'll end with this. The county continues to avoid, and we haven't had any direct exposure to Russia. We continue to avoid it. We have filters in our systems to make sure that we're not going to buy anything like that to be in accordance with the current rules. Everything is well diversified. There's a certification in your packet that demonstrates that the investments continue to follow California government code, and we'll continue working as a team with your Treasury to make sure that we keep an eye on liquidity, making sure that you have money when you need it, and investing to capture the highest yields possible for the lowest amount of risk. Let me stop there and take any questions you may have.
Supervisor Sabatier?
Thank you very much for this report. I think a year ago compared to today is immensely different and outrageous, actually. It's amazing. Do we know what was, you said 3.3 million, is that actual interest that we've received over the course of the past year, or is that kind of continuously reused and reinvested?
So Supervisor Sabatier, that is an accrual-based earnings. So it's everything. It's
Okay.
As you're aware, when you purchase a bond, bonds only pay off every 6 months. So if you're not buying it on the day that it pays off, whoever held it before you, you had to pay them their interest from the prior payment date to the day that you buy it. That's called a purchase of accrued interest. So that's factored in there. If you sell a bond, there's a sale of accrued interest. That's factored in there. And then, of course, as you hold the bond, the payments only come every 6 months, generally every 6 months and that varies per bond on which dates those are. So while you're waiting for that, the interest that's there is accruing to you, meaning it's entitled to you, but you won't receive it until the next payment date. So that this number includes those accruals, meaning income that's yours, you've earned, you're entitled to it, you just haven't received it yet. And it also includes those payments that have been paid back to you, that have been redeemed. So if there was an interest payment date and the payment came in, that payment is in the portfolio. So it's a very holistic view. That's called an accruals-based earning, to give you a full view of what you own, whether you've received it or not. And of course, that interest gets reinvested back into the portfolio, into securities.
Okay. Because I know that I was speaking with the auditor controller, and I think I mentioned it in my report a week or so ago, that we had a $600,000 interest payment that we had received for one specific quarter. That's unheard of for the past at least the years that I've been here. So appreciate the work that Chandler has been doing, has absolutely turned things around. Will you be coming to us once you have better key factors known of the economy to see if we want to change kind of our strategy for maybe longer terms or things like that? Or is there already kind of a foresight of this is maybe when we want to do that? Or is it completely unknown because the economy is still very not predictable at this moment?
Supervisor Sabatier, it's our practice to revisit this once a year with the Treasury and the Treasurer Tax Collector. I think the question is, does this strategy continue to make sense? Right now, the strategy you have is an absolutely great strategy for the environment, but it's also a good strategy for the long run. It was selected more with the liquidity needs of the Treasury, making funds available for the participants when needed, and for that effect, it's very useful and it's efficacious. It's doing its job. It just happens to be that we're in an environment where it's also very much in favor. Now, we may enter into an environment that's not in favor, but that's not necessarily a reason to change it. The reason is because you get into a situation where you start trying to time how to shift the overall strategy, and at some point you will not be able to call that timing incorrectly, and it could damage the portfolio. So we try to avoid that. But to your point, on an annual basis, we come back and look at the strategy and say, does this continue to make sense? Do we have enough of a risk appetite to be able to target a longer duration target, have more investments in longer maturities, and are we still meeting our liquidity and safety requirements, and are we okay with that volatility? That discussion we tend to have annually. Generally, what we observe is that most treasuries, this is a really good spot to be in because it's really good at providing liquidity when needed. It gives the Treasury a lot of options.
Okay. And then our annual, is that January? Because I know we started in September or something along those lines.
That's correct. The first statements that we cut were in September as funds came into the portfolio, but we really didn't implement. I want to say that the implementation of the strategy was around October, November. So that's what we're calling the inception date when we really started kicking off. So to give you an idea, income for September was $23,000. Income for October, this is 2021. Income for October 2021, $66,000, so it tripled. Income for November, $63,000, a little bit lower. Income for December, now you're $101,000. It doubled. And then that went up to $221,000 in March. That went up to $3.5 in May of this year. We hit $440 in July. Now we're at $545 per month. So that's been a good run. You've maintained a shorter duration to be able to capture that rising interest rate trend as the Federal Reserve has raised interest rates to slow inflation down by reducing the money supply. The application of this strategy has been very good.
Shown by your graph. Thank you very much.
Thank you.
Supervisor Green?
Yeah, thank you. Love pie charts. I saw a 0 on the pie chart for local government investments. And a quick question, City of Lakeport recently issued a pension obligation bond as we flattened out our unfunded accrued liability for pension costs. And POBs are kind of a new animal, and I don't know if they popped up on the county's radar at all, but that strategy, and I don't know if the county's examined it either for that matter, but it was an important process for the city. It was hugely important, and I think that bond issue came and went, so it's not like we're looking for people to buy. But this strategy for some of our smaller districts, fire districts, special districts, what's have you, I mean, anybody that has pension costs probably needs to take a look at least the possibility of funding it in different ways, and the POBs are one way to do that. So one, are POBs on our radar at all, and is it something we can identify in our strategy? It's like, again, I don't know how many other districts and county are going to be considering these, but if they are, I'd like them to be on our radar. If not saying it'll be a big moneymaker, not saying it'll get up to 0.5% of our investment portfolio, but it would be nice to pay it forward in some respect to help our local governments that are considering POBs, and also to reap whatever dividends we can get off those.
So Supervisor Green, to answer your question, they are most definitely on our radar. We do look at POBs. One of the projects that we took on when we began this investment program with the ad hoc committee and the Treasury and the Treasurer Tax Collector was to revamp the county's investment policy, to really bring it up to date, to include everything that's allowed by California code through 2021, which is the last time we updated it. We try to update it annually. And one of the things that we did is we opened up the investment policy to be able to include municipal securities as allowed by California code. So that absolutely they're on our radar and they are allowed. Now, having said that, not just the City of Lakeport's pension obligation bond, but any other municipal issuers of pension obligation bonds or general obligation bonds or revenue bonds, obviously we look for criteria for them to meet to be able to provide liquidity and safety in the portfolio. We look at the size of the issue, how widely it's held, the credit quality, all those factors. But I wouldn't say no to any security until I analyzed it and looked at it. But yes, it is on our radar, and we do look for those, and they are allowed in the portfolio. If it makes sense to bring it in vis-a-vis the other opportunities that we have in the portfolio, absolutely, we could bring something like that in.
Thank you.
Supervisor Pyska?
Carlos, I appreciate your guidance on this and being involved in the committee and the strategies that you've suggested. This is growth that we haven't ever seen, and I just really appreciate working with you, and I'm looking forward to the January meeting. And, this is just another example of, you pushed this forward, and it was a small investment on our time to put this strategy together, but amazing results and dividends. And so thank you so much for guiding us, and we're in excellent hands.
Supervisor Pyska, this has been a great relationship to work with the county and the Board of Supervisors and the Treasurer Tax Collector and the Treasurer Tax Collector-elect, the whole team. It's been a lot of hands in this. It's been a good project. I'm excited to see what this next year is going to bring. not just from an economics perspective, but also just from a growth of the pool.
Yep.
Did you have anything to add, or?
No, we don't have anything further to add.
All right. Go ahead.
I do have one quick question. Have we heard anything from our other partners in the investment pool? Or is there a level of excitement from them about the changes that they're seeing and what they're receiving? Or I haven't heard anything. I've heard the opposite when there's nothing coming in, but I haven't heard any comments lately.
I have not heard any comments.
I'll have to check in.
I have had contact with the Office of Education, and they did seem pleased with the progress that was being made.
Awesome.
Good.
Because it affects more than just us. That's why I asked.
All right. I'll open it up to the public. If there's anyone in the chambers or online that would like to comment on this item on the agenda. And I'm not seeing any hands or anyone coming to the microphone, so I'll bring it back to the board. This is a report, so thank you very much. Thank you for the report, and thank you for the work that you've been doing and the partnership that we have.
Thank you, Supervisor. Thank you, everybody. Have a great day.
We love getting good news from you all the time.